Okay, hello everybody. This is a continuation video to wrap up the rest of chapter 13 that we didn't get to prior to beginning chapter 18 this week. And so we're obviously these rooms are not always available, so it's kind of hard for me to make a time to get in here. But I do want to kind of go over some of these topics that we didn't get to with regard to chapter 13. Obviously, the chapter 13 content was due previously, but it will still be covered on the final exam, so it should be useful to you. Now, so when we talk about chapter 13, what are we really talking about here? We're talking about current liabilities as well as contingencies or contingent liabilities. And I think we got pretty much all the way through current liabilities and what they are. And these are, again, these are obligations of the firm to deliver something. It's usually a claim on assets as a result of some past activity, and they're expected to be settled within a year or the operating cycle, whichever is longer. So that's essentially the definition. However, there arise conditions and situations in which it's not always clear what the amount of the liability is. It's one thing to buy inventory on credit from the supplier and get an invoice and see if any account payable. It's pretty straightforward as to what that is. There's not a lot of ambiguity there, but and even things like taxes that are payable, even though sometimes it's not always clear what the tax liability is, once it's established, it's pretty obvious what that liability is, even being a current liability. But in the case of contingent losses, it's really not known as to what amount should be recorded in order to meet the accountant's objective of being transparent with users. And so I think that's really the challenge here with regard to the loss contingencies. So we talk about a contingent liability, or we'll talk about gains in a second, but primarily we're really talking about losses for the most part, and because this really is sort of a continuation of the liability piece. It's really dependent upon some existing and uncertain situation involving a potential loss, depending upon some sort of future outcome, whatever that case might be, whether it's product liability, whether it's some event that may cause liability to the firm, lawsuit. We think of lawsuits as being a big contributor to contingent liabilities, and we'll get into a bit of how, under GAAP standards, we should record those, and then also get into a little bit of the comparison between GAAP standards and international standards, which are a little bit different. And as we've been saying many times before throughout this course. All right, so when we talk about whether or not we report it, how we report it, do we accrue it, that is, put a dollar figure on it, and therefore say it's a liability? It really depends upon the discussion of these three questions. Is the event probable, reasonably possible, or is it remote? And these are really important questions because the entire treatment of this potential liability really depends upon the answer to these particular questions. And so let's talk about what these contingencies are really all about, based on the context of those three elements of probable, reasonably possible, or remote. All right, before we do that, let's talk a quick loss contingency question. Which of the following is not true regarding loss contingencies and their disclosure? And the answer here is the company is required to account for loss contingency when the amount gave rise to it before it occurred before the end of the fiscal year. This quiz question is a little bit out of order because we're going to get to this a bit later when we talk about when the company, that is the reporting company, knows there's a contingent liability, whether it's before or after the end of the accounting period, and then what to do about it. And again, it goes back to these three questions: is it probable, remotely possible, or is it remote? And so, probable, reasonably possible, or is it remote? And so once we know the answers to those questions, we can decide what to do about it. The timing is a little bit trickier, just simply because of the fact that sometimes companies really don't know what's going on until sometime after the reporting period is over, but before the actual statements are prepared. So there is this sort of gap in time in which full disclosure and transparency are necessary. And so this particular matrix, this is actually in your book as well, and I think it's on page 271, I believe, in your text. Maybe, and I don't know what illustration this is, but it's maybe a little bit better, easier to look at in your text, but it's definitely in chapter 13. This very same sort of matrix here that you want to look at. First of all, remote means And so let's just kind of take this is a sort of a 2x2 matrix. And so what have we got going on here, right? Or a 3x3, I guess we should say. We've got the likely it's probable, reasonably possible, remote, and then the dollar figure that of the loss to be recorded as a liability if we know what they are, what the liability amount is, whether it's known, reasonably estimable, or not reasonably estimable. So if the outcome is probably remote, there's no disclosure required either in the notes, and definitely not on the balance sheet as to be recorded as a liability. Remember, in this chapter and throughout the last several weeks, and in the last week of the course, we're talking about the balance sheet primarily, and we're working our way through that, and we're on the right side of the balance sheet under liabilities. So in this case, if it's remote, then we're not going to record anything at all, because there are remote contingencies that exist all the time out there. We sometimes know about them, and sometimes we don't know about them. But if they're remote, then we're not going to record them just yet, okay? And as things materialize over time, that could change. If it's reasonably possible, then there's a disclosure note that's going to be necessary, but nothing that accrues and is posted on the balance sheet as a liability. And the liability will obviously get credit balance, and then the debt will be some expense, some loss that's recognized as a result of how you balance that transaction. But if it's only reasonably possible, then all you're going to do is disclose a note. And here, there are all kinds of examples in which this is potentially possible. So, for instance, things which we know are going to create some liability. Some event happened where there's a liability that's going to happen. Then the company will certainly disclose what's going on, even though the dollar figures are really not estimable at that time. Think about something like a plane crash, for instance. And I mean, these are really horrible events, or the shootings in Las Vegas that caused the casino operator of Mandalay Bay to have to, set aside funds, but they didn't know exactly what the liability was. And obviously, these are really, really awful events, but nonetheless, they affect companies, and we sometimes have to deal with awful events in terms of the recording of these transactions. And so if we're pretty sure there's something that's reasonably possible, then there's going to be a disclosure note. Now, in the case of some of these, like a plane crash, I think you could maybe make a reasonable assumption that it's going to be probable. But what if the amount is not reasonably estimable because it just happened? So really, who knows what's going to happen in that case? I can guarantee you, in the case of plane crashes of airliners, there is always litigation that's involved, always, always, always. And there's going to be some sort of amount that's going to have to be set aside by the parties to whom the courts find responsible for the particular event in question. So if it's not reasonably estimable, there is a requirement to disclose that in the notes. Now, as we go sort of to the left on this top line of the matrix, once we sort of know what's reasonably estimable or known, we're going to go ahead and accrue the liability. That's we're going to debit a loss for whatever it is, if we have a pretty good idea of what it is, and then we're going to credit the liability for that particular event. And then if and when it's paid, then you're going to, debit that liability to zero it out, and credit cash or whatever, sort of consideration is being given, and that will remove that. But the loss will have been incurred at the time that we estimated it reasonably. And by the way, there's a lot we could say about this, and I know that some accounting textbooks get into great detail as to when these liabilities should be posted. And it sort of verges really, I think it probably gets more into advanced accounting where you get into this issue of what does legal counsel inform management about? Do they have a pretty good idea that there's going to be a loss, and therefore how do we treat that? And if there's a pretty good idea there's going to be a loss, then we say the likelihood is probable. If they don't know the dollar amount, then it's disclosure note only, right? If they have a pretty good estimate of what the amount is going to be, then we go in and record that. And if it's obviously if it's known, like the judgment has already been rendered, then we would simply do the same here as we would over here. But the question is, at what point does legal counsel believe that there's a liability? And I say this mostly in the context of litigation, that is civil litigation, I suppose criminal litigation as well, where the company, as the reporting company, has got some sort of liability for something that it has done or failed to do or failed to comply with, and so as a result has generated a liability. And this is where we get into a little bit of it's a little bit tricky because who knows? I mean, lawyers are obviously not infallible, and so they can make errors in judgments here. But I think they probably have a pretty good sense of when their client is going to lose even if the client is their employer, and I know that certainly when I was in the corporate world, we had our own attorneys who would sort of handle most of this for us, and so and they would sort of tell us this is the way things are. This is where you're going to lose, and so this is a match you're going to lose. And maybe let's cut our expenses, let's cut our losses early, that sort of thing. All right, so here's the transaction. As I think I mentioned a minute ago, debit loss, credit liability for that. And then when it's resolved, then obviously you're going to zero that out with debiting the loss. And then you're going to credit the probably cash or whatever it is that's going to be paid in order to resolve that. And again, this really refers, I think, more to litigation. There's legal sort of issues than it does to things like warranty expenses. We'll talk a bit more about warranty and whatnot in a second. But when we talk about this idea of companies having liability for some actions or inactions that they're doing, it's a fairly routine and common thing. And we'll talk a bit more in a second about some of that and why it's a particularly challenging issue. Okay, let's talk about product warranties and guarantees. So obviously product warranties, these are sometimes standard features of the product itself, whether it's a guarantee, we're going to guarantee you 1 year satisfaction, bring it back or whatever, or there's a warranty for X number of years or whatever, or a number of miles or amount of usage, or whatever the case might be. And so a lot of products, particularly when the consumer is the end user, are given these. And we're not talking about the extended warranty. We'll get to that in a second. That's really considered a separate product offering with its own, separate journal entry and whatnot. But we're simply talking about something which is a feature of the product itself, which means it's really a cost of doing business that is an expense of delivering the product. It's not really part of cost of goods sold. It's nonetheless an expense that's incurred, where the idea is to try to match it up with the revenue in the period in which it was earned. So when we talk about warranties, we know that the company offers a warranty that, if the product breaks down in 2 years or whatever, the company will replace it or pay you off or whatever the case might be. And so we know there's going to be a contingency. Now, we don't know what the future may hold at the time we sell the product. We sell a product on November 30th, and we have no idea whether or not that product is going to last 5 years, 10 years, 2 years even, which may be the warranty period, who knows. But it's informed by past experience. And this is really what is important about the recognition of the expense and the liability that go along with it. It's really informed by past experience. It's not that much different, really, than accounting for losses on receivables, where we really don't know whether or not we're going to be paid 100% of our receivables. Probably not. Accounts receivable, I'm talking about trade receivables. But our experience tells us that some percentage are going to be uncollectible, and so as a result, we're going to use that to inform ourselves in terms of creating the allowance for those particular losses by recording an expense. And also, and that's simply the way that we're going to sort of address the loss ahead of time. And so that we can match it up against the period in which the revenue is generated. That's what's the so-called matching principle in accounting. We want to sort of match expenses and revenues to the best we possibly can, even given the fact that expenses here are estimated. And they may change, they probably will change. And anybody who does a perfect job forecasting is probably not a human being, because it is subject to lots of guesswork, or educated guesswork, I would say. So when it comes to product warranty, an example here is Caliber Health, which is a supplier of healthcare products, introduced a new chair carrying a 2-year warranty. Estimates based on industry experience indicate warranty costs. Now, this is a 2-year warranty, so we're going to capture the next 2 years of potential liability for the firm, 3% the first year and 4% the next. That's 7% total. So the initial journal entry here is going to be $2 million debit to cash. That's what the sales were, and $2 million in sales revenue. Obviously, these are aggregates. I'm sure they didn't all happen all in one day, but I think you kind of get the idea as to what's going on. So that's the initial transaction. But what we need to do is adjust it for the liabilities. And so in this case, we said, all right, let's just kind of go back to the original facts here. 3% the first year, 4% the next. That's 7% in total. 7% of $2 million is $140,000. So as a result, we're going to accrue at that year. Remember the year of sale, which was what, 2021, right? Yeah, 2021. We're going to accrue $140,000 of warranty expense. That's the debit. We're going to accrue a warranty liability of $140,000. And so the next year, as we're doing this, because this happened, I think, late. These sales happened late in 2021, I believe. Yeah, it was first month of availability. So in the first full year, we're going to incur 61,000 of warranty liability. So or expenses, and we've already expensed it though. So all we're simply doing is debiting warranty liability to reduce that, and then cash in terms of whether it's whatever it is, whether it's new equipment, new inventory, cash, whatever the case might be, is we're going to credit it. Some asset, obviously, we're going to credit in order to satisfy that liability. And obviously, we're off a little bit. Our warranty liability came in a little bit hotter than what we thought, and this is to be expected. We would like pleasant surprises as opposed to unpleasant surprises, but this is not a big miss. And in fact, I think if your budgeting is that good, you're probably pretty close to where you need to be. And again, budgeting is something that's the process of determining what the future is, just based upon past experience and good judgment and reasonable expectations about what's going to happen in the future. Okay. All right. So that's one method there. And let's go back here a second and talk about warranty liability. Okay. And this is what we call the best estimate of future cash flows. Okay. And this particular method, in this case of Calder, the firm Calder, which sold home medical products, they're not discounting this for the time value of money. There's another approach, and it's called the expected cash flow approach, which is a little bit more rigorous in the sense that because some of these expenditures are not going to happen right away, we will discount these for the time value of money. And I think the discount rate used, which could be anything that's reasonable. Sometimes we use, it's called the risk-free rate. Sometimes we use, the firm's own cost of capital or whatever. In this case, we're getting a little bit into finance here, but the key thing is we would use a discounted cash flow method because the warranty liability is not going to happen the day of sale. It's going to happen next year. It's going to happen a year, 2 years from now, whatever the case might be. And so those are incorporated into that. So and these are particularly useful when it exceeds 1 year. Remember, beyond 1 year is we're getting into anything within a year is sort of the short term. Over that is more of a long term. But even within a year, we can still discount that for the fact that it's not payable really right away until some point. And again, we still have the element of estimate, a probability. We really don't know precisely what's going to happen in terms of the outcome here. Maybe we have zero defects and zero warranty expenses. Probably unlikely, but it could happen. So in this case, we're going to say, okay, so these are the products we sold in 2022, 50,000, 60,000, 70,000, and they had respectively the probability of loss of incurring warranty expense, 20%, 50%, 30%. And then the same goes for 2023, same dollar figures times these. And so if you bring these over here, then you're going to have the total dollar figures which will rise from that. So 50,000 in sales with a 20% defect on that. Not these percentages are super high, I would imagine, but nonetheless, let's just kind of go with them. So 50% times 20%. I'm sorry, 50,000 times 20% is going to be 10,000 over here, and 60,000 times 50% is 30,000, all the way down the list here. And so let's just take 2022 first of all, which is the first full year after these goods were sold. And we're saying, okay, we're going to discount these because they're not payable now. And we're going to use n equals 1. Remember, go to your present value tables, right? This is present value of $1, not the present value of an annuity, the present value of $1 at a discount rate of 5%. Where'd that come from? I don't know. We're just assuming that they know where it came from. And it makes sense. And whether it's right or wrong, it doesn't really matter. You're probably not going to be asked to do that on anything. But if that's the case, 5%, 0.95238, that's the present value interest factor that's multiplied by that to get 58,095 is a liability that's going to be recorded against those sales that happened in the year 2021, knowing that there's a 2-year period for these warranty expenses to come in. The same goes over here, but now you get a lower factor because it's further out in the future. So we have to discount that even further. And it's simply just the same table here. Now it's n equals 2 with the same interest rate equals 5. And all you're going to do is simply go to your present value table or use a financial calculator. Present value tables are everywhere. They're in the back of accounting textbooks. They're online. You can find them pretty much wherever. I think, and I can't recall because I don't really use the physical text very much. I'm not even sure where my physical text is, but I think you probably have tables that you can look at in order to get n equals 1, n equals 2. The same deal, 81,000, which is the amount that we've weighted based upon the probabilities. These are sort of weighted figures, times the present value interest factor, gives us for 2023, 73,469. So for the 2 years together, we have 131,564. That is the warranty liability we're going to record upfront as an adjusting entry, really, as we go forward. And so what's the transaction going to look like? It's going to look like this. It's going to be warranty expense in December of 2021. That's the year end, presumably year end of 2021. And so warranty expense, debit, warranty liability, 131,564. And as claims come in that 2-year period, we're simply going to debit warranty liability to remove some of it, and we're going to credit cash or parts or whatever the case may be, inventory, whatever it is, in order to account for that. Okay, so that's how we treat this particular issue of warranty expense. And I think companies are probably pretty good at estimating what their warranty liabilities are. Obviously, nobody likes warranty claims or guarantees where somebody says, "Hey, I'm not satisfied, so your money back guarantee." Obviously, no seller likes that. I don't think they do, at least. But nonetheless, it's a feature of the product itself that's going to be accounted for as a feature of the product itself, which is why in 2021, the year of sale, we record the expense at the same time that we record the revenue, so as we match that expense up with that. And because that was when the sales were actually incurred, and we will charge off these the actual expenses as they roll in against the liability itself. Okay. And that's what product warranty is about. And these are the ordinary routine expenses that we see when companies sell products or deliver services that simply do not meet customers' expectations. And if there's a really ironclad warranty available, then oftentimes customers will take advantage of it, and companies therefore have really no choice but to sort of comply with that. Okay. Okay, so that's, as I mentioned a second ago, when we talk about warranties, if it's part of the feature of the product itself, then we have to record an expense that goes along with it. It's not really cost of goods sold, as I said a second ago. It's really more an additional cost that's going on. But here, when we talk about extended warranties, this is a separate product altogether. And a lot of companies, we see this happening with a lot of retailers. If you buy a refrigerator or a lawnmower or any kind of durable good, they want to sell the extended warranty. Car, motorcycle, boat, whatever, extended warranties are often being sold, often by the retailer themselves, even though they're not really the seller, they're more the agent for the seller, and they'll probably get a commission that's sort of retained back to them and whatnot. But nonetheless, it's a separate product, and it's priced separately from the actual warranty product. These typically are optional; that customers don't have to buy them, and there's some controversy over extended warranties and whatnot, and it's really hard to sort of pass judgment on all extended warranties. I know that there are those who have railed against extended warranties as an entire product class for a long time. I don't know that that's that fair of a statement. I know a lot of people who buy extended warranties on pretty much everything, and sometimes they swear by them because they say, "Hey, look, my dishwasher is going to break. I use it every day, and I use it 4 times a day. I run it 5 hours a day, or whatever the case might be. And so I need that extended warranty." So, all right, so that's fine. But let's not debate the merits of the extended warranty. Instead, let's talk about the treatment of extended warranty. That's the idea. It's a separate item, and so it's recorded as we're going to recognize revenue in the period in which it's sold. And we're talking, I think we're going back here to the manufacturer, not the retailer, because the retailer is just simply a pass-through entity here. And they're going to record the revenue, and they're also going to record the liability at the same time. Now, the revenue is going to be a deferred revenue, which is a liability. Remember, so go back to deferrals. What is a deferred revenue? It's something we haven't earned yet. So somebody pays, I don't know, $500 for an extended warranty for 5 years or whatever. Well, okay, so you get $500 up front, but you haven't really earned it because the 5 years have not expired. And it's going to expire over time. It's a time-based amortization. On a straight line basis, there is no accelerated method here, at least that I'm aware of. It's all on a straight line basis. And so over time, as the company earns it, they're going to record the revenue. independent of whether or not they're actually warranty expenses, because we have a different way of dealing with that. The revenue recognition is going to take place over time. So here's the example. Brand name appliances sells appliances that carry a 1-year warranty. Customers are offered the opportunity at the time of purchase to buy a 3-year extended warranty. This is a separate product, okay? And it's going to be for $60, okay? I don't know if this is 60 million or like if it's aggregate or whatever. Let's say it's 60, it's one customer, whatever. So cash is going to be collected for 60. That's a debit, obviously increasing cash. And 60 is deferred revenue, extended warranties. It's an unearned revenue. It's a liability. It's a deferral. Remember, with deferrals, the money comes up front. It's the activity that comes later. What's being deferred is not the money, so don't follow the money, follow the activity. So if we're paying for it up front, or the buyer is paying for it up front, and the earning of that revenue takes place over time. It's a time-based situation, okay? And so that's the initial transaction. And then right below that, on December 31st of the next year, we have adjusted, actually the next 3 years, over 3 years, the 60 is going to be earned 20, 20, 20. And so we're going to be debiting deferred revenue because we've now earned it, and we bring it over to revenue, and that's a credit balance because we now earned that. And we've said nothing here about claims against that, because as claims come in, we have a way to sort of deal with that. These are losses, and so claims against that. And so hopefully, from the standpoint of the company offering the warranty, the revenue exceeds the expense of that. But I suppose there are instances in which that doesn't always happen. Okay. All right, so quick question here. On October 1st, 2021, Major Incorporated sold a $480 snowblower with a $120 extended warranty. The warranty covers 3 years of repairs during 2021. That is the year of sale, right? And we're going to assume, I think, that the year end is December 31st. Major would recognize warranty revenue of what? Okay, well, first of all, let's go back to what extended warranty is. It's a product that's separate from the original transaction itself. So the 480 is irrelevant to this. That's a separate transaction. Again, buyers typically have the option. I don't know that sellers can, require people to buy the extended warranty. I mean, I'm sure it's happened before where there's arm twisting and whatnot, but it's a separate product. So the $120 over 3 years. Okay, so and in this case, we only got 3 months. So if you take 3 years, 120 divided by 3 is going to be 40. And we only had 1/4 of this year, that is October 1st to December 31st. So it's going to be $10. 40, divided, well, it's going to be 120, and it's going to be a portion of that. I don't really like the way they put it here. I would rather just say 120 over 3 years, right? It's 3 years, and so that's going to be $40 a year, and we only used a quarter of a year, so 40 and a quarter of 40 is 10. So that's one way to look at it. That's simply an adjusting entry that we recognize warranty revenue. Remember, accruals and deferrals both are posted at some point and have to be adjusted as time goes by for the reality of what's going on. In this case, these are deferrals. This deferral of revenue, and as the revenue is earned, we simply take it out of the deferred status, which is a liability. It's current liability. We debit that out. We credit revenue in order to recognize that. That's independent of whatever kind of claims have come in against it. That's not what we're really getting at here at all. Okay. All right, so let's talk a bit about, we're sort of jumping around a little bit. I'm not terribly pleased with the way this is organized, because I would have liked to have gotten more. When we talked a bit about contingencies in general, I would have sort of liked to have just talked about litigation at once. But litigation contingencies obviously involve some sort of legal process that's involved, whether it's brought by private parties, whether it's brought by government entities, by foreign governments, by whomever. And as a result, there could be a liability that accrues to the firm, and the firm has to recognize the loss from it, and also a liability arising from it. So, and this statement of accruable loss from pending or ongoing litigation is where, yes, it probably is, mostly because litigation sometimes goes on and on and on forever. And so it's really hard to know. And then who knows what's really going to happen at the end of the day. When we talk about things like product liability and civil liability, sometimes these things take a very long time to work out. And the litigation can go on literally for years. I know my wife worked in the accounting department at Dow Chemical back in, I think it was the late 80s, early 90s. and they were dealing with litigation from U.S. soldiers in Vietnam who were exposed to Agent Orange. That Dow was a producer of Agent Orange as a defoliant, I think it's a herbicide or whatever, but it was considered to be quite dangerous to one's health. But this litigation was going on and on and on and on, and at various points they had to sort of increase the reserves. We talked a bit about reserves that are sitting aside assets to cover those, but they didn't record any liability because the litigation was really ongoing, and it took a very long time to sort of wind down. So yeah, it does happen, but oftentimes we just don't really know what the outcome is going to be. And if we do know the outcome, if we don't know the dollar figure, all we can really do is prepare a note to the financial statement saying that we don't know, and that's essentially what's going on. And so this happens quite frequently. So let's take a look here. I've got an example. I pulled up the 10K, which is the annual financial statement from Kroger, which is a big, large supermarket retailer, the parent company of Smith's, and I think Fry's and King Soopers and others. I think we've talked a bit about them before. So one nice thing about these that are posted in the EDGAR site, which is the Securities and Exchange Commission site, is you can click on item 8 and then kind of scroll down here. We're going to scroll a bit. And by the way, a lot of these notes here are things we've already talked about before, and I don't want to get too much off track here, but things like comprehensive income and cash flow. We're going to get to cash flows in intermediate 2 and whatnot, but I want to come down here. It's down here a ways. I didn't really mark it, but I'm going to show you real quickly here how a company would record in the notes to a financial statement something that's going on. And there's one in particular that I think it sort of hits home to us here in New Mexico. And so we have commitments and contingencies. These are liabilities that may arise. And so the company describes various claims and lawsuits arising in the normal course of business, including personal injury, slip and fall kind of things. People get hurt in their place of business. And so as a result, these things are pending. It's really hard to know exactly what's going on. Contract disputes with union workers, employment discrimination, all this. By the way, I will say this, if the more you look at the financial statements of public companies, it is most likely you'll see that every company is involved in some kind of litigation at all times. And that's why they have legal departments. There's always somebody who's got some sort of claim, whether or not they're meritorious, or whether or not they have a chance of success, or whether they'll ever be resolved in the complainant's favor is sometimes irrelevant. There are examples of it is very often the case that companies are being sued or being pursued, or there's regulatory action that's being brought against them by government agencies, whatever. It's more common than not that companies will be involved with this. And so it's just part of the cost of doing business is the idea that you're going to be engaged in that. To make matters a bit more complicated, if you're doing business around the world, different regulatory systems have different different requirements, and so a lot of things can happen. So here I want to point out this is in 20. This was, and by the way, the 10K I pulled up is for 2024. They didn't mention it in 2025. I did pull up 2025's report, but so Kroger's saying that, and I'm assuming these are millions. The company in 2023, the company recorded a charge of $85 million related to a settlement of opioid litigation with the state of New Mexico. So Smith's, right? I don't think that they have any other subsidiaries operating here, but I may be wrong. I don't know. But obviously, they had pharmacies, and so they had some liability. And I believe the Attorney General's office in New Mexico brought a claim in one of the first states to go against some of these distributors of opioids. And I don't know what the facts are. I'm just simply saying this is what we're seeing. All we're seeing is what we're seeing. And so we're allocating $85 million to my various constituents related to the state of New Mexico going after purveyors of opioids. And so we've heard a lot about opioids, and without making any kind of judgment as to what the whole thing is about. Nonetheless, we're saying here, in this case, we're accruing this, and this would be an accrued liability. Remember, if we know what the dollar figure is, that it's not just probable but very much known, then we do a note to the statements, but also put it on the balance sheet itself as a liability, and not a contingent liability. The contingencies, if something is going to happen, man, we don't know if it's going to happen or not, and therefore that would just simply be a note. But here The dollar figure is known, and I believe this was settled. I think I had come across this news story. I'm a pretty avid consumer of business news, and so I think they just settled with the state, and it was done. And so, but this is the kind of thing you're going to see, and all kinds of different elements with regard to this. Things like all kinds of contingencies. Workers get hurt at work, and so as a result, they sue their employer, and so as a result, all these are examples of contingent liabilities, and sometimes they take a while to play out, but nonetheless, there's something that has to be. If the probability of a loss is going to be there, at minimum, the company will record a note in the statements. And again, as I've preached many times before, the notes to financial statements are extremely important. I know that a lot of people just want to look at the numbers, but you got to kind of drill down into the notes to know what the heck those numbers mean, particularly if you are needing to know. Okay, if you're needing to know. All right, so quick example here. This is Ameris Bancorp. I think it's probably a hypothetical company. As of December 31st, 2016, the company believes that it's valid bases in law, in fact, overturn on appeal the verdict. Okay, here we got an issue where the company is found liable. Okay, I'm assuming this is a civil litigation, but they believe that it's probably not going to be affirmed upon appeal, and accordingly, the amount can't be reasonably estimated at this time. We don't know what the facts are at all about what's going on here. All we're simply saying is there are instances in which, and this goes back, this is not a violation at all of the matrix we saw previously. If we don't know what the amount is, we can't accrue the liability, which is a credit balance, and the loss, which is a debt balance. All we can really do is sort of record it. In this case, they believe that it's not going to be sustainable for whatever reason. Maybe it was obvious error made during the court proceedings. Who knows? And I'm not a lawyer, so I can't, delve into all the possibilities of why this thing is going to be reversed. But that's essentially what's going on. Again, when it comes to this, and I think we get into this a lot when there is litigation, and the attorneys are better situated to render judgment on what is likely to happen. And we need to sort of take their opinion, and it informs the accountant's view of the matter. Okay, so in this case, they're saying this thing is probably going to be appealed, and we're going to be successful, and the loss can be reasonably estimated because of that fact. And sometimes these judgments are, often, and we've seen this happen a lot. Where sometimes judgments come in at really, really extreme dollar figures, and then when it goes to appeal, the dollar figures are really cut back tremendously, and so it's really hard to kind of know, but you have to kind of let the process play out. Okay, and again, we would not probably post any dollar figure until you knew, but you would discuss in the notes. Okay, now we'll go back to the timing issue here. So in this case, we got a timeline. That's the red line. We have some sort of cause that's going to create a potential contingent liability. The year ends, and then after the year ends, but not before the year ends, we have some sort of new facts that come about prior to the preparation of financial statements. And so in this case, the example here is the idea that, and I'm not sure what the company is. Oh, it's Kraft, I guess. There's actually against Starbucks that entitled them to a certain dollar figure. I don't know what this was all about, but nonetheless, they're going to sort of post this once new facts are in. They're not going to put it on the financial statements necessarily, unless they know reasonably what's going to happen. But sometimes these facts do arise after the fact. Okay, and then there could be clarifications after the statements themselves are created. And so as a result, you would, you're not going to go back and recreate the statements, probably, unless it's a really material misstatement that you made at the time. But sometimes things happen in different sorts of orders here. Now, in the real world, a public company accounting, these events are generally well known, particularly among the financial community members who are following certain industries and certain firms within industries. They're really looking at these a lot. And sometimes if things come about of the legal nature, everyone is sort of on it. They're looking into it, finding out what's going on. A few years ago, there was a pretty dangerous heart medication or I think it was a weight loss medication that caused heart problems. Yeah, that was what it was, maybe. And immediately, everyone was sort of on it. And it, of course, happened, between financial statement reporting dates. So a lot of this information is now available. It's not like This is all hidden information. This was a pretty big deal. And I forget, I don't know if it's Pfizer, I forget the name of the company that was involved with that, but you kind of get the idea that public company liabilities are oftentimes very much uncovered very, very quickly. Okay. All right. And we talk about claims that have not yet happened. Again, we go back to this process of saying, is it probable that a claim will be asserted? And if it's probable, then we move on to the next level. And we sort of treat it as to how much we know about based upon that. Is it probable? Is it reasonably estimable? Is it unlikely? But if it's probable, then we're going to treat it. If we know the dollar figure, maybe we accrue it. It really depends upon what the facts and circumstances are. If it's not probable, then we don't do much at all with it whatsoever, and it's sort of there. And I think this is, a practical matter. There are some differences we'll talk about in a second between the GAAP standards and the international standards in terms of recognition and what the thresholds are for these various items. And it's really hard to say that one is more conservative than the other, which is looser than the other. It's not really all that clear cut. It's just that they're different, and that's what we really need to sort of get into. Here's the idea that they're not uniform across this. And by the way, if you're a publicly traded company that deals in around the world, then you're going to have to deal with these different standards and record these as appropriate given the requirements of where it is that you're operating. Okay, and the same goes for foreign companies doing business here, because a lot of foreign-based companies often also are subject to U.S. regulation if they issue their securities in the U.S., and so they have to conform to GAAP standards. And so, yeah, maybe it'd be nice if we had one set of standards for the world, but it doesn't look like we're that close to seeing that happen. So, all right, so to the point about GAAP versus IFRS standards, under GAAP, all accrued and possible obligations are called contingent liabilities, right? And it's pretty much the same, although the word provisions are used for the accrued liabilities, and so that's a little bit different. And I mentioned a second ago, thresholds are different. There's a higher threshold for what's probable and a lower threshold for what's probable. I'm sorry, higher threshold in the GAAP standards and a lower threshold in the international standards. And without getting into this, if you really, really, really want to get into it, you can actually get into the IASB's website, iasb.org, if you're really interested in what those thresholds are. And they're pretty detailed, as is for GAAP. You go to FASB.org and find out what those thresholds are. But for right now, I think it just suffice to say those thresholds are a little bit different. Also, the estimate of the range when a liability is accrued, it's going to be taking the low end of the range. Under IFRS, it's more of a midpoint, so it's a little bit different in that regard. Also, loss contingencies for GAAP are not typically discounted for time value of money considerations. That is, we're not discounting it to the present value. However, if it's a material amount, and there are tests of what's material and what's not, then these liabilities are going to be stated at present value, which present value implies a discounted amount. Because $1 in hand today, it's worth more than $1 in the future, and so if it's in the future, you got to discount it back to today. And then finally, no disclosure of loss from what are called onerous contracts. That concept doesn't really exist in GAAP accounting. It does in international standards. What this means, onerous contracts refer to any kind of endeavor which the business is operating where they expect to lose money overall on the entire project. It almost always refers to very long-term projects, often involving construction or some sort of big project like a new product or whatnot. And as they're somewhere in the middle of producing this, it looks like they're going to have a liability because they're going to lose. And so in the international standards, they would record this as a liability. That's the credit and the expenses, the debit. We don't have that provision here. An example would be if you're building a golf course and it turns out nobody plays, between the time you start and the time you finish, nobody plays golf anymore. And so as a result, the whole thing looks like a boondoggle. Well, it doesn't make any sense. And I don't know if that's the best example, but there are all kinds of examples in which this happens. It could also be cost overruns that the producer has to eat. It has no way to recover, and that could also be another example. But there is no provision in the GAAP accounting. It does exist in the international standards, however. Okay? All right, then we can talk about gain contingencies. This is treated a little bit differently here than loss contingencies. Let's focus on the GAAP recognition first of all. And in this sense, there really is no recognition at the time that we think we're going to have a gain. And this goes to what's known as the principle of conservatism. Your text gets into this a little bit earlier. Your text is not that big on these principles of accounting, like conservatism and faithful representation and whatnot, as maybe some other texts are, matching and whatnot, all these different sort of principles. But conservatism is simply the idea that we don't want to mislead users of statements by giving them false hope. We really don't know, and sometimes, like loss contingencies, sometimes gain contingencies can't be estimated. And so, how do you really describe what amount is going to be received as a gain for whatever reason? So, but if they're material, you will disclose them as a note, but you won't accrue the dollar figure. Okay, and that's just simply as part of this whole issue of not misleading or giving overly optimistic information to users. That's a no-no really in the GAAP accounting world. And when it comes to international standards, again, we don't accrue these. And by accrue, I simply mean we post it to the statements. We don't do that. Under IFRS, though, they will, if it's virtually certain to occur, and the standard for that is sort of spelled out in the IASB's information and directives in this regard. We'll also disclose when the realization is probable, but there's a higher threshold for probable, higher than what? Higher than international standards as to what it is. And so maybe there's going to be a gain from something happening. When we have a piece of land that's going to be bought by the state of whatever, and they're going to build a highway. And so as a result, we're going to get a gain, but we don't know when that's going to happen, right? We're pretty sure it's going to happen. We don't know. We don't know what dollar figure it's going to be. Is it probable? Well, that's, again, the facts and circumstances determine what the treatment is going to be in that regard. But dollar figures are not accrued in this particular example. Okay. All right. So we only have just a little bit more to go here. We'll talk about another couple examples. GK Inc. has the following outstanding litigation claims. Claim of 100,000. GK thinks it's probable it will lose the claim and estimates the loss at 75,000 if it occurs. A claim of 50,000, GK thinks it's probable it'll lose the claim. We cannot estimate the amount of loss. Okay. Now, we're going to sort of scroll ahead. The question is, what do we record? Okay. The claim of 10,000, it's reasonably possible it will lose the claim, estimates the loss at 8,000. Well, the answer is going to be what here? Well, it's going to be simply what is most reasonable. And that is, oops, lost my train of thought here. So, it's going to be, what happened? I think we lost some of the slide here. It's going to be whatever the amount that's both probable and reasonably estimable. I think some of this got cut off here. I didn't really notice that. But again, this is not all that. This is not really new information. This is what's contained on that matrix, which, again, I think it's page 271. I would sort of encourage you to sort of dog-ear that and have that available. It's going to probably serve you well with regard to that. Okay. Portland's Best Coffee has a litigation claim of 100,000 against it for whatever. As of December 31st of 2021, Portland considered it probable it will lose 70,000. So after the 2021 year end, we're doing the posting to the statements and adjusting entries. But before issuance of the financial statements, Portland settled the litigation. All right, so it's been settled. So how much of a litigation liability should they show in its 2021 statements? And the answer is 60,000, because this information was available. We know it arose from that 2021 period. Now, again, let's think about this idea of what a liability is. A liability is a claim on assets as a result of past transactions, the past or events, right? Or whatever the case, events or transactions, and it happened during the period which this whole thing was going on. It didn't happen after the statement period. It happened during the period. So as a result, we're going to go ahead and post the $60,000 because that's a surety. There's no doubt about what the dollar amount is. The claim has been settled for 60,000. So as a result, that goes into the 2021 statements because it is well known. Okay, I mean, it can't get better known than the fact that they've essentially been already paying it. Okay, and then it looks like, well, I think one final bit here deals with payroll related liabilities, and this is just simply dealing with these payroll accounting procedures that have to be done for payroll, and in itself, we have an entire payroll course that deals with these issues of things like withholding, things like federal tax and state tax, there's income tax and Social Security and Medicare and all these kind of things that go into it. So, and why it's a liability? It's a liability to the company / employer You have employees, you've got to accrue these liabilities, and you've got the responsibility to forward these amounts on to the respective recipients, whether it's the IRS, whether it's the state of New Mexico, or whatever state. In some places, there are local tax authorities, whether it's insurance companies, to unions, in the case of dues, to investment firms. In the case of 401k contributions, there are a lot of different elements of this. And I think a lot of us have gotten paychecks before. We sort of looked at line items and saw that there are a lot of different pieces that come out of one's pay. And the employer is really responsible for posting these as liabilities. They're not due like immediately. Like, for instance, if you have a pay period, you're withholding for Social Security and Medicare out of your employees' checks, as well as your own contributions, because there's a matching contribution on the part of the employer. I mean, it's not due that day. You're sort of going to accrue them as liabilities, and then when they're due, usually on a quarterly basis, then you'll debit that liability out and you'll credit cash, and that will clear that particular obligation. But it is nonetheless an obligation on the part of the employer, and employers are responsible for doing this, collecting what? State income taxes, definitely Social Security. And what the FICA Act, which stands for Federal Income Contribution Act, Federal Insurance Contributions Act, really is intended to collect tax payments to support Social Security as well as Medicare. And it's a joint tax split evenly between employer and employee. 6.2% was for Social Security by the employee, and another 6.2% by the employer. That's for the Social Security piece. 1.45% in Medicare tax from the employer and also from the employee. Now the Social Security amount will max out at a certain dollar figure that's indexed every year for inflation, but most workers don't get to that maximum cap out. And there are also things like unemployment taxes that are collected, and those are both state and federal. And without getting all the mechanics of this, we do cover this in business math here in Business 1180. Certainly, if you took our payroll class, you would have it. But the key fact we want to mention is the fact that the employer has got a liability and has to be satisfied. And by the way, employers would do well not to ignore this. I had a relative in a business and retired, and then he turned it over to his kids, my cousins, in other words, who weren't paying their payroll tax withholding. And it was a big problem. The government's not going to stop coming for their money when it comes to something like that. So you just can't ignore this particular responsibility. And this is just part of the normal procedure. And it's really bookkeeping as much as anything, more than accounting. All you're doing is simply withholding from workers' pay and also from your own contributions, as expenses to yourself, what needs to be paid. So whether it's deductions like things like dues or insurance premiums, payroll taxes, we talked about FICA, and also unemployment taxes, and then all the other things that go out, even things like charitable contributions. I know that some employers I work for would withhold if you wanted to volunteer to pay to the United Way or some other sort of charity that was approved, and they would do that. So here's a listing of some of these things. So it's not a small list, right? It is kind of big here, actually. And notice that there's a graphic that is in your text that I think is interesting, where you've got, in this case, $100,000 of salaries expense, which is a nice round number that kind of helps our analysis, because 6.2% is withheld from employees' pay. That's $6,200, and also $6,200 from the firm itself. And so it's twice the amount that is withheld for the employee actually is forwarded on. And then with Medicare, it's 1.45% by the employer. I'm sorry, the employee and the employer. And also you've got things like Blue Cross, which if the firm is paying 70% of the premiums, there's 70% there. If the employees pay 30%, there's that amount there. And so all these have got to be accounted for. FUTA stands for Federal Unemployment Tax Act, and there's also state unemployment. Most states have a state unemployment tax. We do here in New Mexico. Without getting into all the nuts and bolts of it, just suffice to say that we've got to collect. We are a firm have got to collect, and also for everything else that goes into it. So these are current liabilities, and they've got to be managed. They've got to be managed very carefully. And benefits administrators are sometimes brought in to sort of coordinate some of these things, because it's complicated and whatnot. In terms of the accounting, usually the payroll department is able to do this and it's a pretty manageable job. It's manageable with software. It's when you're doing it manually, not so easy. But I wouldn't advise anybody to do anything manually when it comes to accounting at this point. But nonetheless, these are current liabilities that the firm is entitled to forward out when they're due, and they're going to do it on time. And if they don't do it, then they could create a contingent liability. Because what if somebody, their policy is lapsed or whatever, some life insurance policy? I think we actually had this with one of my employers where they didn't pay the life insurance proceeds, and someone died. They had a very large life insurance policy, and the insurance company said, well, we didn't get the premium, but we don't owe anybody anything. And so the firm itself was liable for that. So, failure to adhere to these current liabilities could in and of themselves create a contingent liability that no one wants, and an additional liability that comes along with that. Okay. So that does it for chapter 13. And we're going to wrap up with chapter 18. And in the final week of the semester, we're going to do on Tuesday, we're going to talk more about what some of the details of chapter 18. The final class session is going to simply be a Q&A. If you want, you can attend, you can ask questions, you can bring up any kind of issues you like. I'll be here. I'll be here the whole time. And so I'm eager to help you if you need help. And I'm here pretty much every day, so feel free to reach out. And if you have any questions, I'm more than glad to help. So I will see you all next time.